Welcome back. We have a special guest this weekend on Wall Street. The co-CEO of private equity giant Carlyle Group, Kewsong Lee, is with us this weekend. And Kewsong, we're talking about investing today in an environment where we did just see a great earnings period in the United States. Certainly the second quarter, 20% plus growth in profits and a great GDP number. The jobs number, obviously out on Friday, was a little lower than expected. How are you allocating capital these days? How has the strategy changed in the last year?
Well, first of all, let me just say, when you have a strong economic environment, that does not necessarily translate to a great investing environment. Valuations are pretty much very high right now across the board. In terms of how we are driving returns, I think the most important thing to understand about private equity these days and private capital really is the nature of our returns has really changed over the past 20 years. It used to be a long time ago, you'd buy a company, you buy low, you sell high.
Right.
Or you bought a company,
anyway.
Right, you put leverage on it, and because of financial leverage, you could juice up the returns on the equity. It turns out that at least at Carlyle, 60 to 70% of all our returns now are generated by just fundamental top-line growth, efficiency, corporate improvement, really creating value. So start with that the nature of the job has changed and what we do has changed. In terms of where we're seeing opportunity, we take a very long-term orientation. We have the luxury of being able to do that. And we are of the view we have to be able to drive this value improvement in all these companies because we're paying up for all these companies. Nobody is getting great bargains or deals in today's market.
Yeah.
We're seeing great growth in China. We see tremendous opportunity in carve-outs and very complex and large transactions out of corporations. And we're also seeing an interesting genre of deals where they're private companies. They would have accessed the IPO market maybe 10 years ago, but they feel that partnering with private capital is a much better way to go. And so we're seeing, I would say, growth opportunities in much later stage, large private companies that continue to want to be private as opposed to wanting to become public.
Yeah, it's interesting. It feels like more and more companies don't want to be public.
Yeah, and the numbers bear that out. At its peak in the U.S., there were 600, almost 700 IPOs. Today, latest 12 months, about 120, so dramatically down. Throughout the world, you're seeing public equities fall in terms of the number of stocks even available to be purchased. So very much, I think the role of private capital is expanding. That's not to say there isn't a role for public capital. There surely is. It's just that we can provide so many new solutions in terms of trying to help management companies grow their businesses, that there's a real value add that we provide partnering with these private companies and enabling them to continue their growth without the scrutiny of being public.
Yeah, so tell us about some of those partnerships. From an industry standpoint, you've had your hand in energy for a long time. Yes. Are you still expecting oil prices to be up and the business of fracking and gasoline development? Is that still one of your big focuses?
I'm not a predictor of oil or gas, but I can say over the past several years there was a tremendous pullback out of the energy sector, and we think the sector still has underinvested for the capacity that it does need to provide to meet demand. So I do think there are opportunities, broadly speaking, in energy.
Where else? What are the industries that you're mostly invested in?
Healthcare in general, globally, I think is tremendous. Clearly, the convergence of technology into, be it consumer, business services, even industrial sectors, I think all present tremendous opportunity.
It's changing every industry. Technology is.
We have a saying at Carlyle: there is no deal that is not a technology deal.
Do you want to lower your exposure to places like Europe, given that the growth levels are not as high as we thought they would be at this point?
We do not think about investing from a top-down perspective where we're saying, let's just allocate X, Y, and Z.
Right.
It's very much a bottoms-up, company by company, investment thesis by investment thesis approach. And so I guess my question to you would be no. We still see plenty of opportunities in Europe. It's just a matter of finding the right management team with the right company and finding the right thesis that we're excited about.
And China, you know this region well. We were questioning 6% growth anyway, 6.5%. But when I hear 5% as it relates to China, then I start thinking, wow, something has materially changed.
Right. Well, I do think that it's a smaller economy than the United States. Relatively speaking, the tariffs will probably hurt China more than the United States, just in terms of aggregate numbers. There has been, like I mentioned before, a little bit of a drop in confidence in the consumer sector. And you have to imagine that in combination with the wealth effects I talked to you about, where the markets are down, real estate prices haven't really gone up, that may all start to be having an effect. But also, China's been an amazing success story.
Yes.
It's grown unbelievably well for so many decades. And 5% ain't bad.
All right, we will leave it there. Kewsong, it's great to have you on the program.
Thank you for having me.
Congratulations on your success. Kewsong Lee joining us there, the Carlyle Group. Thanks so much.